Assalamualaikum warahmatullahi wabarakatuh, and good morning. This series of lectures will be talking about the topic of accounting for merchandising operations. Previously, in our last lecture, we looked at the complete accounting cycle for a service-based operation. So today we will extend our knowledge and look into how would merchandising operations have their accounts a little bit different from the service operation. Okay, just as you recall, a service operation is a business that conducts service in order to get cash or to get revenue. Okay, they obtain revenue from providing services such as an accounting firm, such as a law firm, such as a car repair workshop. Okay, but today we will be looking at the merchandising operations, which do purchase and sell items in order to obtain profit. Okay, so for example, Tesco, okay, supermarkets, okay, or you go to a shoe shop, okay, you buy shoes at the shoe shop. So the shoe shop is a merchandising operation. So there are some differences, quite significant differences in the way that they handle their accounts. Okay, so today we will be looking at the merchandising operations. Okay, so primarily the merchandising operations would conduct their operation in terms of buying and selling goods. They would buy finished items probably from factories or from wholesalers, and then they would sell the goods to retailers or to end consumers. Okay, so their primary source of revenue is referred to as sales revenue, or just simply put as sales. Whereas in the service operation, we will state their revenue as service revenue. Okay, service revenue. But for merchandising, we call it as sales revenue or just sales. Okay, so it shows here some examples like Amazon.com is merchandising company, Walmart. Okay, these are examples. Okay. There are some differences in terms of how income is measured. Okay, because of the slight differences in the operations that the two types of organizations go through. Okay, so merchandising operations would firstly conduct their sales. So from their sales, they will receive sales revenue. Okay, but before they conduct their sales, they needed to purchase the items for sale. Okay, so in terms of matching of the sales revenue with their expense for that sale, the expense for that sale is called cost of goods sold. Okay, so when the sales revenue, we minus that with the cost of goods sold, or generally speaking is the expense related to the sale, it will equal to the gross profit. That's the gross profit. Okay, what do you mean by gross profit? Gross profit is the profit obtained from selling items. Okay, the difference between the cost of the item and the sale price of the item generally would equal to the gross profit. But then after obtaining gross profit, organizations would also incur other expenses, or which are not directly related to the sale. Okay, not directly related to the items being sold. So that is called operating expense. And after deducting operating expense from the gross profit, the company will achieve net income, or not profit, net profit, or net income or loss. Okay, so this is slightly different from the service operations, because the service operations, when they conduct their service, when they achieve their revenue, service revenue, that service revenue will be deducted by the expenses and then they would obtain their net income. So there's an additional two additional steps. All right, there's two additional steps for merchandising operations. Okay, here's a little bit illustration of the difference of the operations between the two organizations. Here the top diagram is for a service company. Okay, so firstly the service company would perform their service, like in this picture. This mechanic is repairing the car, and after repairing the car, they will charge to the accounts receivable. Okay, after performing the service, accounts receivable will be created because the client has not paid for the service, and then the client sends money, okay, and the company receives cash, and that will involve the debiting or the addition to the cash account. And then they will continue doing next service. For merchandising company, there's some additional step which in the end will generally make the merchandising company to have a longer operating cycle rather than the service company. Okay, so what the merchandising company needs to do, firstly, with their cash, they need to buy inventory. Okay, they purchase inventory. After they bought their inventory, they will receive and update their inventory accounts, and from that inventory, they will sell their inventory. And after selling the inventory, if by credit, then they will create the accounts receivable because they have sold the inventory on credit. And then after charging the customer will pay, and the company will receive cash. And here they will update the cash account. So there's some additional steps. It takes a longer period for the merchandising company from cash to receive to get the next cycle of cash. Okay, as compared to the service company. And let's see about the cost. Okay, the flow of cost. All right. So the operating merchandising operations will have a beginning inventory. Okay, so but usually the beginning inventory that they have is insufficient for them to make sales. So they need to purchase additional inventory. So they have a beginning inventory, and then they purchase some goods. So the purchase of goods have the cost to it. So when the purchased goods are added to the beginning inventory, the original inventory that they have, this is called cost of goods available for sale. Now they have the original inventory, they have a new set of inventory that they have purchased. So this is called cost of goods available for sale because they have these items available for sale. Okay, so that's the cost for that one. After they sold, well, when they sell those items that are available for sale, not all of those items were sold. So those items that were sold, that were successfully sold, those will be called, the cost for those items will be called cost of goods sold. Okay, because they are looking at the cost of those items that have been successfully sold. But then some of those items available for sale were not successfully sold. So those will become the ending inventory. Okay, so they have originally they have some inventory. They will buy new items. Those two will come into a pool of items available for sale. But then after the sales transactions, then most of those available for sale will become the cost of goods sold. Items will be sold. But then there was some of them will be remaining as an ending inventory. Okay. Here also we need to note that there are two types of maintaining or looking at the cost of items. But cost of items, cost of goods sold. There are two types here. The first type is the perpetual inventory system, and the second type is the periodic inventory system. We will look at both of them in more detail in later slides. Okay, right. So the first one is the perpetual system. Okay, we look at the difference in terms of the wording. Okay, before we even go. Before we even look at it in more detail, the difference is in the first word. The first one is called perpetual, and the second one is called periodic. Okay, so perpetual relates to being continuous. Okay, periodic means broken into time periods. Okay, perpetual means it's continuous. Periodic means it's broken into specific times. Now we look into the perpetual inventory system. Okay, so in the perpetual system, detailed records are maintained for the cost of each inventory when they are purchased and when they are sold. Okay, so when inventory is purchased, we will update our inventory records. When we sold those inventory, we will update our records. Okay, so it's ongoing and our inventory account is continuously being updated due to purchase transactions as well as sale transactions. Okay, because our records is maintained all the time. Therefore, we at any particular time we should be able to show the amount of inventory that we have on hand. Okay, because we always update our inventory account, we should be able to know at any particular time how much is the inventory that we have in our warehouse, for example. Okay, so in the perpetual system, company also determines the cost of goods sold each time a sale occurs. Okay, so when we go back to the matching principle, okay, and the revenue recognition principle and the expense principle, okay, we recognize revenue when we incur when we perform our service, or in this case when we sell our items, we should recognize this as a revenue. But at the same time, whenever we make a sale, there's some cost associated with the sale, which is the cost of that item. So at that particular time, at that particular moment, we immediately recognize that there's a cost that we need to expend. Okay, so in the perpetual system, whenever there's a sale, we should also recognize a cost to it, and that cost is called cost of goods sold, and this should be recorded every time we make a sale. Okay, we will show how we do this. Okay, but for the periodic system, we do not keep detailed records of the goods on hand. Okay, our inventory accounts is not updated all the time according to the purchase or sale transactions. Okay, instead, the inventory account as well as the cost of goods sold is determined by counting the amount of inventory, the remaining inventory at the end of the accounting period. Meaning that in order for us to determine the amount of the cost of goods sold, we need to go into our warehouse, we count the individual items physically, and we calculate how much is the value of all the total inventory, and we know now that will become the ending inventory. And from that ending inventory, only then we will be able to calculate the cost of goods sold. So this is how we calculate the cost of goods sold. So we have a beginning inventory at the starting of the period, and then we have net purchases. Okay, the amount or the cost. This is the cost of purchase. Okay, cost of goods purchased. So adding the inventory and the purchases, we will have goods available for sale. But then to know how much is the cost of goods sold, we need to look at the ending inventory. So this is the cost of available inventory, and then at the end we look at the ending inventory, the inventory that is left. So the difference is the difference is the inventory that has actually been sold. Okay, the difference between available inventory, and the ending inventory is the inventory actually been sold. So that will be recognized as the cost of goods sold, which in the end we will deduct from our sales revenue in order to calculate good costs. To calculate gross profit. Okay. All right. There's some advantages of the perpetual system. Okay. Usually the perpetual system is used for merchandise with high unit values because in perpetual system additional work needs to be done because we have to keep track of our inventory, or we need to update our inventory records as well as our cost of goods sold every time. For the inventory we need to update our inventory account every time there's a purchase or sale transaction, and the cost of goods sold needs to be updated every time we have our sale transaction. Therefore, traditionally, organizations that sell low values of their items don't take up the perpetual system because it has a cost in itself. It's extra work. Okay, so traditionally the perpetual system is used for high unit values. The perpetual system shows the quantity and cost of the inventory that should be on hand at any time. So at any particular time, we will be able to know what is the inventory that we have on hand because we always update our inventory as well as our cost of goods sold account. And it provides better control over inventories than a period system because now we have an evaluation system. We have one, we can check the records. We have an updated record, but secondly, we can also check that against the actual quantity on hand. So there's a checking mechanism. Whereas in the periodic system, there's no checking mechanism because there's only one way for us to rely on getting the inventory amount, which is by looking at the or counting the ending inventory in our warehouse at the end of the period.